Right now, an economic mechanism holding over $1.2 trillion in United States assets is reversing its flow, draining capital directly out of Western markets. The catalyst for this drain is happening in Tokyo. Japan's 10-year and 30-year Treasury bond yields just hit their highest levels in over 2 decades. Japan is the largest foreign holder of United States government debt. When their bond market experiences a massive shift, the American market is forced to move mrado-levet. For decades, Japan maintained uniquely suppressed interest rates. Because borrowing there cost practically nothing, the Japanese yen became the primary funding currency for global liquidity. To see how this impending liquidity drain actually works, we have to deconstruct how a shift in Japanese monetary policy directly dictates United States mortgages, domestic stock valuations, and the dollar itself. This chart compares debt to GDP ratios. The U.S. sits at 125%. 90% is the danger threshold. Japan reaches 260%. At the peak, the grounds of the Imperial Palace in Tokyo were briefly valued higher than all the real estate in California combined. When that extreme asset bubble finally popped, it plunged the Japanese economy into a grueling 15-year deflationary spiral. While inflation decreases the purchasing power of your money over time, deflation is the exact opposite. Deflation creates a consumer expectation that goods will cost less in the future, which mathematically destroys the incentive to spend any money today. If a citizen knows the price of a drink in a local vending machine will be cheaper next month, they will simply delay their purchase and wait for the price to drop. When millions of people adopt this psychology, the entire system freezes. Consumers stop buying, inventory stalls on the shelves, businesses fail to generate revenue, and wages stagnate. To break this frozen economic cycle, the Japanese government had to step in as the ultimate buyer of last resort. They borrowed and spent massive amounts of capital to stimulate the economy, directly creating that 260% debt load. Managing this economy requires 2 independent levers. The government borrows money by issuing bonds, and the Bank of Japan controls the monetary policy. To keep the government's exploding debt manageable, the Bank of Japan initiated quantitative easing, printing massive amounts of money while keeping their interest rates at 0, or sometimes even negative. This graph illustrates their most extreme policy intervention, known as yield curve control. Yield curve control is a central bank mandate that establishes a hard cap on exactly how high bond yields are allowed to rise, effectively locking them near 0. To successfully enforce this cap, the Bank of Japan had to purchase 50% of all outstanding government bonds. In the critical 10-year bond market, the distortion is even more severe. The central bank currently owns an unprecedented 90% of that entire market. When a central bank steps in as the guaranteed majority buyer of its own debt, it artificially drives the price of those bonds up. Because bond prices and yields move inversely, this mathematically forces the yields down. As a result, the Japanese government amassed $8.6 trillion in debt, but their actual cost to service that debt remained virtually 0. Yield curve control acts as an artificial life support system that completely suppresses sovereign default, but this delicate mechanism only functions correctly as long as the entire country remains locked in a strict deflationary environment. Operating within this zero-rate environment were Japanese institutional investors, like pension funds and insurance companies.
Starved for yield domestically, they looked outward. This created the opportunity for the yen carry trade. Step 1 involves these institutions borrowing massive amounts of yen directly from the Bank of Japan at a near-zero interest rate. Step 2 is immediately converting that borrowed yen into United States dollars. The final step is deploying those newly acquired dollars into higher-yielding American assets, specifically U.S. Treasuries and equities. This diagram maps the pure arbitrage loop. By borrowing capital at 0.1% in Japan and parking it in United States Treasuries yielding 4.5%, an institution creates a guaranteed 4.4% profit spread. Scaled to an institutional level, a $1 billion loan generates $44 million a year in pure profit, all for taking virtually 0 fundamental risk. For years, this global arbitrage machine artificially inflated the demand for American debt. Japanese capitals systematically subsidized and lowered borrowing costs across the entire United States. But the external shock that breaks this machine has finally arrived. After 30 years of deflation, inflation has returned to Japan.
The cost of everyday goods is climbing. A basic rice ball, an onigiri, that used to cost 120 yen has jumped closer to 140 yen, an increase of more than 10%. To combat this inflation, the Bank of Japan must reduce their bond purchases. Removing that artificial purchasing cap allows yields to naturally break upward. This chart shows the new reality. Japanese 10-year yields have crossed 2.1%, and 30-year yields breached 3.3%. At these higher rates, servicing Japan's debt instantly consumes 25% of their national budget, roughly $230 billion a year. Compounding this problem is Japan's rapidly shrinking working-age population. The national population is projected to drop to roughly 75 million by 2100, leaving a much smaller tax base available to pay this exploding debt burden. The central bank is now caught in an ultimate sovereign trap. They must either leave rates artificially low and suffer a devastating collapse in the value of the yen, or raise rates to fight inflation and trigger a domestic debt crisis. This brings us back to the yen carry trade and the concept of unwind risk. The arbitrage math is now broken. With Japanese borrowing costs rising above 2%, combined with currency conversion and hedging fees, the once lucrative profit spread between the US and Japan is shrinking toward zero. To avoid taking losses on this trade, Japanese institutions are forced to reverse course. They are unwinding those investments, selling off their United States assets, converting dollars back to yen, and investing domestically. When the largest foreign holder of U.S. debt starts unloading assets, it creates massive, mechanical, downward selling pressure on U.S. Treasuries. If foreign demand for Treasuries drops, the U.S. government must increase yields to attract new buyers. Higher Treasury yields directly increase domestic borrowing costs for the American consumer. On Main Street, even a 1% increase in mortgage rates on a $400,000 home adds $250 to a monthly payment. Over 30 years, that totals more than $90,000 in extra interest. On Wall Street, corporate valuations are calculated using a discounted cash flow model, which takes a company's future earnings and discounts them to the present using an interest rate as a baseline. When risk-free interest rates go up, future earnings are mathematically worth less today, which suppresses stock valuations. What begins as a flight yield increase in Tokyo mathematically guarantees compressed corporate valuations and higher housing costs across the entire United States economy. Japan is not an isolated case. The United States, the UK, and Europe are all running massive deficits, and they are now aggressively competing for the exact same shrinking pool of bond buyers. There are three ways this pressure resolves. The global market could experience a slow and managed soft landing, which is the most probable outcome. Alternatively, a sudden geopolitical shock could trigger a rapid carry trade flash crash. The third scenario is a full hyperinflationary fiscal crisis. Regardless of whether the unwind plays out over weeks or decades, one fact remains clear. The historical era of cheap American borrowing, artificially stabilized by Japanese deflation, is permanently over.